Hi everyone, welcome to Forecast 2013. My name is Josh Nelson. I am a certified financial planner and the CEO and founder of Keystone Financial Services. We guide our clients to achieve financial security by building trusted relationships and providing expert financial advice, exceptional service, and proactive communication. This presentation was originally given at Marion Butte Golf Course on January 22nd, 2013. Let's get started. Very briefly, today we're going to be discussing a few events that have happened during the past year, where we are now, and where we think we're going to be going here in 2013. So let's talk about where we've been. In 2012, it was a great year. Stocks had a strong year despite many risks entering into 2012. Returns for commodities were less attractive, and bond yields for U.S. Treasuries continued to decrease throughout the year as well, thanks in large part to purchases made by the Federal Reserve. The word of the year in 2012, uncertainty. Political turmoil both in the U.S. and around the globe dominated market headlines all throughout 2012. The year began with fear that the euro currency may completely disband due to sovereign debt default risks. After plaguing the markets for months, these fears quickly dissipated after European Central Bank President Mario Draghi issued a statement that sounded a lot like a quote from Malcolm X, saying he would protect the Eurozone by whatever means necessary. However, as soon as this began to disappear from the headlines, we were moving into the thick of the U.S. presidential election. Both candidates had stark differences of opinions on how our country should move forward, and markets hung in the balance in anticipation of the result. Of course, as soon as we were past that, we started to worry about the fiscal cliff. Essentially, 2012 was a rare year in which political comments and actions stole the attention from the usual economic and business fundamentals that typically dictate the market's direction. We didn't have the catastrophic outcome everyone feared, but we also didn't make things all that much better either. The positives are that tax cuts for 97% of Americans making under $400,000 a year are permanent, and overall sentiment should improve for both consumers and businesses. However, the planned spending cuts have simply been delayed for 6 weeks, and we have technically already breached the debt ceiling. This sets up a major showdown in just a short amount of time, so it's not quite time to celebrate just yet. European Central Bank President Mario Draghi wasn't the only person helping support financial markets in 2012. Ben Bernanke and the U.S. Federal Reserve once again continued to expand their balance sheet by flooding the market with fresh funds. By purchasing massive amounts of U.S. Treasury debt and mortgage-backed securities and driving the returns of these assets to essentially nothing, the Federal Reserve is basically forcing investors to take their money into more risky assets. The past several years have seen developed countries such as the U.S. and Europe struggle to grow, while China has continued to carry the load for the rest of the world. However, it appears that this growth engine is finally slowing down. It was only a matter of time before China's double-digit economic growth rates began to stabilize at a more normal rate. Expectations for growth in China have been lowered and their stock markets declined by more than 10% up until December, before staging an impressive rally through the end of the year. Many believe that this is the new normal, as China ushered in a new set of national leaders who have stated they intend to focus on increasing the quality of life for all Chinese, rather than simply measuring their success by their GDP. One of the leading causes of the last economic recession, housing, appears to finally be stabilizing. 2012 could be the year housing started its comeback. Home prices have stabilized and improved in many parts of the country. Meanwhile, the excess inventory that was holding home prices down declined considerably in 2012. Considering millions of Americans have a large percentage of their net worth tied to their homes, a strong and improving housing market can be expected to provide a great catalyst for overall economic improvement. Often we turn on our TV and hear horror stories about how millions of people have never recovered from the last recession and that people are still struggling. While that's true, it's interesting to note that most people struggling to find jobs are those without an education. In fact, according to the Bureau of Labor Statistics, the unemployment rate in the U.S. is less than 4% for those that have a bachelor's degree or higher. It is a tale of two nations where the educated are improving while the uneducated and unskilled continue to suffer. This is making it much more difficult to get an accurate read on how healthy our economy truly is at the present time. As we spoke about earlier, there were many large risks that we faced in 2012. The European debt crisis, the U.S. elections, and the fiscal cliff all presented a large one-time risk to the financial markets. In statistics, they label this as fat tail risk, where the probability of an extreme event in both a negative and positive direction is higher than usual. The result of this new environment has been, and will likely continue to be, more volatility in financial markets. Investors are most likely at a crucial inflection point. Due to the large one-time risks that are present in the market, we could see a significant downturn in asset prices if something bad were to happen. However, if these risks prove to be non-detrimental or overstated, markets are likely to perform very well once the concerns are removed. There is a lot of work to be done by leaders all over the world before we're in the clear. But if leadership can restore confidence in the investment community by accomplishing what needs to be done, we could see less uncertainty among investors and business owners. However, this is a big if, and the likelihood at this point in time is unknown. This chart helps demonstrate what can happen when there is so much uncertainty about crucial elements of the economy. For example, the fiscal cliff created so much uncertainty amongst business owners that they stopped investing in equipment and software until they knew what their taxes would be and how it would affect the entire 2013 economic outlook. This chart shows the level of total manufacturing output in China over the last 5 years. As you can see, activity swiftly declined in 2008, which coincided with the global recession. Activity has been weak in 2011 and 2012, which would explain the slide we showed earlier highlighting the slowing economy in China. The recent move above 50 may indicate that China's economy is on the mend. It's important to understand the impact China has on the overall economy. As the developed countries like the US and Europe continue to limp along, it will be vital for other parts of the world to continue growing at a brisk pace in order to help support the global economy. This chart would indicate things are looking positive going into 2013. So, is now a good time to invest in stocks? You could easily make the case either way with this slide. The price-to-earnings ratio is a common indicator of whether or not stocks are expensive. In this case, it takes the overall price of the S&P 500 and divides it by the combined earnings per share of all the companies in the index. It is currently right in the middle of where it has traded over the last 5 years, indicating that investors are neither pushing stocks to a high valuation nor selling them into a low valuation. This chart shows you that the U.S. consumer, which still makes up approximately 2/3 of total GDP in America, has improved their mood in 2012. A happy consumer is a very good sign for economic growth. The consumer confidence level is currently higher than we've seen it since before the last recession. However, with the looming tax increases in 2013, it will be difficult for this number to strengthen any further. Now moving into what to watch for in 2013. Here's our top 10 list. As it was in 2012, politics will continue to matter more than ever in 2013. We need to get a feel for whether or not President Obama and Congress will be able to work together to solve some of the structural problems, including the debt ceiling and spending cuts. If the two parties can come together and figure out a way to stop our debt from rising to catastrophic levels, then you will probably see confidence restored to the markets. However, if this doesn't happen, there will almost certainly be short-term pressure on the economy carrying over into the markets. This is an extension from the last slide, but it is important by itself. Politicians could do very little or nothing at all, but as long as business leaders, consumers, and investors feel confident that we are on the right path towards growth, that will lead to risk-taking, business investments, and consumer spending. However, at this point in time, nobody can accurately predict what will happen. In fact, even the most educated experts in the world who get paid to predict where our economy is headed can't come close to agreeing. The Federal Open Market Committee, which are members of the U.S. government who meet several times a year to determine where interest rates should be set, have wide-ranging opinions of what the next 3 years has in store for both GDP and the unemployment rate. Potential military conflict is always an important thing to keep an eye on. However, 2013 seems to feature a higher than usual number of potential risks. The above chart shows the Middle East and North Africa region and the level of risk. Obviously, there are many reasons to be concerned about war, but this region is of particular importance due to the level of energy that's produced. Should conflict break out, a spike in energy prices would most likely occur. This would obviously disrupt the economy for countries that rely on energy imports to fulfill their basic daily needs. Number 4, the central banks around the world have been flooding the financial system with cheap money in an effort to provide a boost to economic activity. Experts have debated how dangerous this could be for the financial system, whether or not it even works. The jury is still out, but one thing that seems to be clear is that when large announcements are made by central bank authorities, the markets rally. We should be ready to expect the central banks to step in and intervene once again in 2013. We've discussed China several times. Their new leadership regime has a new priority to remake their economy. Nobody knows exactly what that means quite yet, but it will be important to pay close attention. We have an idea they will focus less on investing in state-owned companies and concentrate on improving the lives of the everyday citizens. This could mean slower growth in the short term. This chart shows what that could potentially mean for the commodities markets. China was responsible for the majority of the growth in several key commodities in 2012. In fact, about 2/3 of the consumption growth for corn was in China. Should China's economy sputter, it will have a large impact on the commodities markets. Of course, if growth is better than expected, that would mean it could continue to drive the prices of commodities higher as well. Number 6, an interesting theme that is developing is that of onshoring, or bringing jobs that have been shipped overseas back to North America. As wages increase in China, manufacturing is actually going to be less expensive in many cases here in America after you include the cost of transportation. Should this trend continue, it would provide a nice tailwind to economic activity here in the U.S. in 2013 and beyond. A major trend helping to support the previous slide's onshoring transition is the recent boom in energy production here in the U.S. Thanks to modern drilling technology, the U.S. is producing the most oil since 1991, and we met 83% of our energy needs in the first 6 months of this year. In fact, the IEA projects the U.S. will be the largest oil producer in the world by around 2017. This is truly an amazing turnaround in a short amount of time. As this trend continues, more companies will be bringing manufacturing back to the U.S. to take advantage of the lower energy costs, providing a major tailwind to economic growth. While the stock markets have been relatively weak over the past decade, corporate profits have actually continued to increase substantially. Unfortunately, a lot of the profits aren't being reinvested as corporations sit on a pile of cash. Companies in the U.S. have stockpiled over $1.7 trillion of cash. This is nearly double the amount corporations held at the beginning of the millennium. Why will businesses do this? They're obviously not confident enough to reinvest those profits just yet. At some point, however, this trend will reverse, and once that cash comes back into the economy, it could also prove to be a major tailwind for growth. Over the past few years, we have seen some extreme weather. While difficult to predict or prepare for, these events can have a significant impact on the global economy. And finally, number 10, stop watching CNBC. It's important for us to remember that investing requires professional guidance and a lot of patience. Just like watching YouTube can't make us experts on being a surgeon, neither can watching CNBC make us experts on investing. Now, our good friend Jim Cramer of Mad Money on CNBC, he's had a few times when he's been wrong. And I'll point out a few of them here. No, Bear Stearns is fine. Bear Stearns is not in trouble. Don't move your money from Bear. That's just being silly. Don't be silly. This was March of 2008, right before Bear Stearns plunged into the oblivion and ceased to exist. Second one, Mr. Cramer later told his TV audience to buy Wachovia, calling it one of only a few potential winners in the $700 billion bailout. This was September 2008, right before Wachovia was forced into a marriage with Wells Fargo. It's time to buy. This was June 2008, right before the market took its huge plunge. And finally, whatever money you may need for the next 5 years, please take it out of the stock market right now, this week. October 2008, when the market was near its bottom. The world is full of constant uncertainty and chaos, and 2012 proved to be especially stressful for investors. However, if we look back at our history, we have endured much more difficult times, and humanity continues to improve. Keep calm and carry on was a phrase created during World War II by the British government with the intention to provide a boost to the morale of citizens of the UK. Posters with this message were made to be displayed to the citizens if an invasion by Germany were to happen. This message lives on decades later as a reminder that when failure is imminent, we've persevered, and also as a source of inspiration that things are hardly ever as dreadful as they may seem in the current moment. So no matter how tumultuous the markets become, keep calm in 2013 and carry out your investment strategy with a grounded focus on your long-term needs and goals. And as always, thank you for your continued support. I appreciate you listening today. If there's anything at all that we can do to serve you or your family better, please don't hesitate to contact us. Our web address is www.keystonefinancial.org. Thank you.